Welcome to Industry Focus. I'm Nick Seipel. Regular listeners will know I recently got married, and thank you to everybody who reached out with some well wishes. As you can imagine, I didn't pay much attention to the stock market on my honeymoon, and as you know, we ran a few pre-recorded episodes over the last few weeks. That's why Lou Whiteman is joining me today to catch us up on some of the stories we missed while I was off getting hitched. Lou, welcome back on the show.
Glad to be here and congrats. I can't believe you weren't paying attention to the market the whole time. There's shame on you.
Yeah, with the big time difference out there in Hawaii, it's like I would wake up and I'm like, man, the market's already getting ready to close here. So yeah, it's interesting to be back on the East Coast time, I guess the master time zone when it comes to running things like stock markets and things like that. And excited to get back in the swing of things, Lou. So we're going to talk about some earnings reports, some news that happened over the past month. Where do we want to start out here today?
I was thinking, I have to start with Boeing because they are just so big, and it was finally some good news, right? Boeing first profit since the third quarter of 2019, 40 cents per share on the per stock basis. Just for comparison purposes, analysts were expecting a 72-cent loss. So it was a really, really big, really impressive headline number.
Yeah, we've got people heading back out flying. I just mentioned went on my honeymoon. The airport was very crowded. Every plane I got on was full to the max. How much is this kind of rebound we're seeing in travel? We'll see whether that continues. We got the Delta variant, things like that out there. But how much of this current rebound in travel is that contributing to what we're seeing in these numbers from Boeing?
We're seeing a tiny bit of it over on the service side. One of the real cool things about this is every one of Boeing's three businesses, commercial, defense, and then services, which is kind of aftermarket and spare parts, they all just blew away expectations. And certainly we're seeing some of it in the services side as far as what's going on in the world. But really, and we can talk in a second, there were some one-time things we need to at least temper ourselves a bit, but really this was just, gosh, they're back, and it's good to see because we haven't been saying a lot of that for a long time.
Yeah, we've been waiting to see Boeing kind of get out of this, time in the wilderness. We had the 737 MAX scandal. Then, of course, we've had global travel shutdown, which, of course, is going to impact one of the companies most levered to global air travel. So what are these caveats folks should be paying attention to in this earnings report, Lou?
So we're going to hear timing a lot with this report, and that's not to say anything is bad here. It's just good to know as we're thinking forward. Commercial is still losing money. They lost $472 million. That was better than expected by more than $100. Some of that was just the timing of R&D investments. There wasn't a lot spent in research and development relative to expectations. So that's going to catch up with them eventually. We still have about maybe upwards of $4 billion in compensation liability related to the problems the 737 MAX had. And that's just payments or credits they are going to have to give their customers. Little to none of that came out in the quarter. So again, that's just kind of looming there, and we're going to see that. The news is good. They are getting back on track. 737 MAX production will go to 31 frames a month in 2022. That's maybe double what they were doing a couple months ago. But again, it's important to remember that absent all the issues they've had, both COVID and the MAX issues, they would be pumping those out at 50-something, mid-50s a month right now. Across the board, defense backlog fell. I'm not too worried about that. We'll talk about that more with other companies, but it seems like the Pentagon was maybe slow in getting awards out based on what we're seeing for defense companies. The big thing, I think the big takeaway, the thing to note in terms of before we get too excited is net debt, $63.6 billion. Basically unchanged. If you go back a few years, that's 4 times higher than it was. It's very abnormally high for Boeing. They aren't making a lot of progress on that right now. They have to do that to really get healthy, and it'll come. They're just not there yet. I think given the timing, given all of the choppiness, we're still heading in the right direction, but certainly I wouldn't say, wow, it's all over, it's all up from here. I would bet we'll see a lot of these things pull back on them a little in the third quarter.
Yeah, the analogy that comes to mind is you got this big cruise ship turning around. Sometimes you got to do that Austin Powers turn, right, to get it. And maybe Boeing is going through that a little bit. So you mentioned the commercial business kind of coming out of the time in the desert, have had still some concessions to make with customers. We've talked about in the past about how you look 5 years ago, Boeing really had all the leverage in this relationship, and how it's shifted somewhat towards the airlines being in a little bit stronger position. How would you assess that now? And when you look, some of these airlines have reported, how do you view them in the market today?
So I'm going to give a real simplistic answer, but I think sometimes looking at things simple is the way to do it. If you look at United's huge order during the quarter of over 200 planes, Southwest doubling down on its order book. These aren't for today. This is not their scrambling to get metal. This is them seeing opportunities to do a deal now. And I think it really is probably that simple. The airlines are motivated to lock in for the future because of pricing. I joked when the United order came out that it might have been a BOGO, buy one get one free, and that is a joke. I don't think it's that bad, but certainly Boeing is still at a position where they need to move metal and they need to price appropriately. So I think this is good for Boeing because we need cash. I remember they burned through $20-something billion in last year. They need free cash flow. They'll get free cash flow from selling planes. So this is where they are, but this is still a buyer's market for new planes, I think.
All right, Lou, any last things maybe we should pull out of this Boeing earnings before we move on to Lockheed Martin?
Well, I'm going to even get grumpier on the third quarter because we knew this was coming, but Airbus has officially unveiled its A350 freighter today. Boeing for a long time has had a near exclusivity on large dedicated freighter planes, not converts but these planes that are built for cargo. This has been a real program saver in a couple of cases, like the 767, where they had no competition. They could keep the program going and make it economically viable thanks to cargo. Those days are changing. That's a long-term thing for your radar. It's not gonna ruin them, but that was a slam dunk business that is going to get a lot harder in the future.
Competition makes things a little bit more complicated, and airlines and just like any other business. So Lou, you mentioned we talk a little bit more about defense with some of these other companies. This company we want to talk about right now is Lockheed Martin. What's going on with Lockheed Martin? What does that tell us about defense more broadly?
So this is probably one of the most interesting earnings reports we've seen. For one thing, so the headline numbers are kind of boring this time. $6.52 per share, which was a penny shy of consensus. So call it a wash. Revenue was about 100 million ahead of expectation at 17 billion. This is a huge company. This is the world's largest dedicated defense company. The intrigue here is kind of, if you look behind the scenes at what drove these numbers. Everything worked at Lockheed except for one thing. Lockheed took an unexpected 61-cent per share charge on a single classified program. That's $225 million in one quarter on a single program that was unexpected, which is just a huge miss, whatever you want to call it. But and I'm not saying you can back that out because that counts, but back that out and this would have been a blockbuster. Even with that charge, they were basically flat versus expectations. By my math, 49, maybe 50 cents per share in an operational beat. Without that, there was also some tax credits and stuff to get that at full 61. We had all four divisions see revenue come in ahead of guidance, all but aeronautics, where that charge was, beat on margin. Lockheed's business is a massive, they got fighter planes, they have helicopters, they've got missiles, they've got space, they have all sorts of things going on, and it's all working right now.
Yeah, so you mentioned that one mysterious charge, a classified program with any of these defense companies. There's a level of mystery to what's going on whenever you get inside that black box of classified programs. But kind of seeing through that haze, Lou, any deeper thoughts or things we can think about as investors there?
Well, so this is fascinating. Yeah, obviously it's classified is the answer, right? But we can sort of guess, and actually, there's a real bull case to be made if you want to go down with some speculation. We know it is in aeronautics, which is where, they do a lot of things in there. It's where a lot of their R&D comes out of, but it's mostly their fighter plane, their plane program. I think it's quite possible, if not growing likely, that what we are looking at is the next Air Force fighter, this top secret program that we first heard about 18 months ago. We were on here, I speculated at the time, I thought it was Lockheed Martin and not Boeing and Northrop, but this charge really sort of makes me think it is, especially, Lockheed wasn't real subtle. Management was saying, yes, this stinks, and yes, they had to actually change guidance for the rest of the year because now they're just baking in more expense going forward with this. That 225 was maybe only half of what the added expense is, but they believe there's a production contract to come out of this, and they seem giddy about that. If it's the fighter plane, we are talking not only a multi-billion-dollar new franchise that'll come out of this, but also Lockheed keeps its winning streak going. Boeing and Northrop haven't won a fighter plane contract in either of our lifetimes basically now, and so these are franchises that Lockheed wants to hold serve. If that turns out being what it is, yes, there's going to be short-term pain in this past quarter. There's going to be a little higher expenses, but they seem really confident that whatever it is, it will lead to a production contract, which should mean it'll level out. And if it is this fighter plane, then yeah, that is another tent-post franchise that Lockheed has under its umbrella, and it's a big deal for them.
Yeah, so this is one of those where you see the headline says earnings missed, but then you dig in a little bit and it's a bullish miss, if you want to put it that way.
Yeah, exactly. And look, this wasn't the perfect quarter. They, similar to Boeing, the defense, we just didn't see a lot of orders. Their book to bill, which is kind of a rough measure of orders that came in versus what they billed out. So we want to see that. The higher, the better, because it means the business is growing. Their book to bill was 0.66, which is terrible. Some of that is the F-35 order they expected just didn't come in this quarter. But Boeing said that, Lockheed said that, General Dynamics said it too. I'm guessing that's on the Pentagon side of it, but certainly something to watch. Free cash flow wasn't what we expected. Again, it looks like tax timing and stuff like that. But there are some things definitely to watch for the third quarter. But all in, this is a well-run company that might have another hit on its hands once you get through whatever this classified is.
Yeah, so something to watch. So moving on from this aerospace sector that we talked about with Boeing and Lockheed, let's talk about Tesla. Electric vehicles are on the tip of everybody's tongue. Every automaker on the face of the planet is trying to chase Tesla into EVs. What are we seeing from Tesla, the top dog here?
Well, it's funny. By Tesla standard, this was a pretty, I don't want to say boring, but this was a pretty just run-of-the-mill quarter. And I mean that much to their credit. I mean, the headline is great. A record quarterly profit, record production, record deliveries. The chip shortage, which is affecting all of these automakers and is causing a lot of pain. Tesla on the surface seems to be navigating better than most. Elon Musk said that they achieved the output that we did achieve. Here's the quote: was only due to the immense effort from people within Tesla. We were able to substitute alternative chips and then write the firmware in a matter of weeks. That's not an easy thing. They had to basically reinvent this, but apparently it's working for them to keep production going. I mean, you have $1.1 billion in GAAP net income, first profit excluding credit sales, which is a huge deal and something that critics really love to bang Tesla on. So all in, there's fodder for the bears always with this company, but all in, you got to say this was a decent quarter, I think.
Yeah, I think for me, the been kind of two criticisms of Tesla for me have been one, when are we going to get a real kind of non-beta product for full self-driving? We'll maybe talk about that a little bit later. And then two, when are we going to make profit directly from selling these vehicles without kind of getting government subsidy involved or these types of penalties involved with selling the credits? And we got that this quarter. Now, this is still, I think if you look at the valuation, I think it's very, very, very richly valued, but the company is performing from an operational perspective. And it's really tough to see much to criticize here. I think this is a really strong report from Tesla. If we want to look out into the future, still developing the Berlin factory in Germany, still developing the factory in Texas. Both of those are going to be developing the Model Y, still pushing the timeline back somewhat for Cybertruck and the Semi. Part of that is they cited supply chain issues. Part of that is you got to have batteries to support all these programs. And, with record deliveries, there's lots of demand for the 3 and the Y and things like that. What jumped out to you for kind of future projects for Tesla and things to watch?
So a few things on the things to watch, and again, a lot of these are speculative, but this is Tesla, so much of it is forward-looking. For one thing, the fact that they substituted the chips, I think, is great. But remember, this is a company that got in trouble a couple of years ago because they weren't using automotive-grade monitor screens, and they had to recall all of that. So I have no idea, but that was the first thing I thought of when we found different chips that no one else could find. Hopefully, they're automotive grade, and it won't come back to bite them in years to come. But hopefully also they learned from that lesson with the screen. So, but that's certainly a long-term watch thing. And also on the batteries, yes, the semi is delayed because of battery issues, but let's be honest, this is a battery that they haven't really showed yet too. So we got to kind of hope. They still seem to think they'll get there next year, but this is a higher power battery. The Plaid launch hasn't seemed to go as they hoped, and that's again, using some of these newer battery techs. So I think there are still questions about the semi's viability, and Cybertruck. I just don't know what to say about that. I don't think. I mean, in a way, it seems like they are rushing it because of the Ford Lightning and some of the things, but I just don't think that's the same market. I think it's more Tesla still needs to get new product out on the market. Their product lineup, by and large, especially on the high end, is starting to look stale by automotive standards. So I don't know if it's a reaction to Ford as much as we need to get new products out the door, and Cybertruck is one that people seem interested in.
Yeah, so we've got the 4680 cells under development. Got some real discussion on the conference call. I think these are going to be lighter, more efficient, cheaper. Working with partners to get these up under development, but still in a testing phase. Still something that that they need to work towards mass production. That's something you hear Musk talk about a lot on these earnings calls, is the difficulty of getting from this prototype phase to mass production, whether it's for vehicles or batteries or anything else. Still something that Tesla is working through along those same lines. Talked some about full self-driving. They launched that as a subscription just in this most recent quarter, charging $199 a month versus what had previously been a $10,000 option. But Musk on the call talks about we still have some development work left to do. Says, quote, "We need to make full self-driving work in order for it to be a compelling value proposition. Otherwise, people are kind of betting on the future. I mean, right now, does it make sense for somebody to do FSD subscription? I think it's debatable, but once we have full self-driving widely deployed, then the value proposition will be clear." I think that's a really important lever for Tesla to pull. We're also starting to see more of these other automakers launch similar products. So we just saw GM sue Ford for using Blue Cruise because they say it infringes on their patents. So we're seeing some of these other folks get involved in the space. So I want to talk about one other thing, Lou. So we've quoted Musk several times here. We heard that this might be his last earnings call, or he's not going to regularly participate in earnings calls going forward. What do you think about that decision? And how normal is it for CEOs to step away from this role?
So we were slacking about this. There's some high profile examples. Jeff Bezos, I think back in the day, maybe Rex Tillerson, because some companies, Warren Buffett doesn't even do it. There are companies that do that. It's funny because Musk is so out there, whether he should be or not sometimes, on Twitter and things. It's not going to be, I can't imagine Musk behind the curtain just not commenting. I tend to think if I was a CEO, these 3-month updates, as both the finances and on the business would be, we want long-term thinkers, and this 3-month grind of it, I bet you most CEOs, if they could, would opt out. But as an investor, I'm disappointed because I do think you can learn from hearing just the off-the-cuff comments, kind of the outlook, the enthusiasm. I think there's a lot we get out of it, but I don't know if it really alters the business. And if I was a CEO, I'd probably want to do that too.
Yeah, I don't think it alters the business. I will say, I find Tesla's earnings calls to be among the most entertaining to read and pay attention to because of Musk. He's always willing to say exactly what he thinks at any moment in time. So maybe it makes the Tesla earnings calls less appointment viewing as they may have been in the past. But we'll get plenty of face time with Musk. They're big fans of these regular events, whether it's the Cybertruck reveal or Battery Day or Autonomy Day or any of these others. I don't think we'll stop seeing Musk at those sorts of events. But in these more institutional investor focused events, I think Musk is stepping back from that. That probably is to the good for him, probably to the good for the company. So, any last thoughts on Tesla before we move on?
Well, just it's interesting because this could be a be careful what you wish for. But part of my answer with Musk, because I was thinking of it, is that this is a company that a lot of investors have wanted to be just a tiny bit more boring, and so maybe Musk going off that way it'll help that and just focus on the business. But at the same time, this was a really good earnings report that the market kind of just shrugged at. And I do think it's interesting. We talk about Tesla's valuation and all that. I mean, part of it is that it was a meme stock before meme stocks. If we're moving into a period where it is more just a stock and not that center of attention, I mean, all the more reason for them to perform, because there isn't going to be just that wild, crazy boost. I mean, long term, it's for the good, but it could alter the dynamics of the stock going forward if it just becomes a stock and not the stock you watch. So, I mean, I think, yeah, that's just something it's going to be fascinating to watch, I think.
Yeah, we'll see how it goes. Tesla is always a fun company to follow. I don't think it's going to stop being that, whether or not Musk wants to appear on the earnings calls or not, but we'll keep paying attention, Lou. One last company we want to talk about is XPO Logistics. Couple interesting things going on with XPO. They've got a split going on, which we've talked about in the past. Also reported earnings. If folks aren't familiar with XPO, XPO is a logistics company. You hear all these big tech companies, whether it's Facebook or Amazon or Google, talking about how much e-commerce is growing, or PayPal or any of these others. This is the company that's facilitating a lot of that for these companies. So what are we seeing from XPO on the earnings side? And then let's get into the split here in a little bit.
Yeah, and I know. And as you say, everyone hears logistics and kind of glazes over. But as I tried to sell this not too long ago, because this is one of my favorite companies, this is the next big thing in e-commerce, and I stand by that. But first of all, about the earnings. And, this is especially interesting. We've all known over the past year that deliveries are up, but we kind of, UPS disappointed by saying, you know what, things are starting to slow. And then UPS's stock fell, I believe, 5-7% after their earnings. So it wasn't a guaranteed slam dunk going in here, but XPO, pardon the pun, really delivered. 186 per share compared to 168 estimates, over $5 billion in revenue, about 200 million more than was expected. They also upped their pre-split guidance. These are all single quarter records. And let's break it down, because this is a business, as you say, they're going to split between sort of the trucking side and the logistics side. The logistics is the e-commerce. We'll talk about that in a second. But trucking, even this trucking, they had their best operating ratio, which is kind of it's a look at how efficiently they operate. The lower, the better. 81% is pretty good for a trucker. It's an improvement of 150 basis points from just the last quarter. How are they doing that? Their loads grew by 33%, but headcount grew by 15%. That's how you do it. A lot of this is a company that's been spending $500 million annually on tech. Part of it is something they call XPO Connect. It's sort of, jokingly, it's a dating app for truckers, but not that way. It matches truckers with customers. It's growing. It's exactly how they want it to be. Year over year, carriers that are using 87%. I'm sorry, carrier growth is up 87%. The customer side, it's up nearly 100%. This is a stodgy old trucking business, but stodgy old trucking business with scale and with tech can be a real good business, especially with the demand out there with shipping right now and some of the backlog. And XPO, that side of it, the kind of the boring old economy that's going to be left after the split, they are really performing almost like no trucker in the business.
Yeah, it's one of those where you mentioned boring business. People don't get excited by it. Maybe that explains the reason for this split. We're splitting off the trucking business, which will retain the name XPO Logistics. And then the warehousing side of the business, the e-commerce side of the business, will be called GXO, will be the newly formed business. And if you hear how they're marketing this company on the roadshow, they're really marketing themselves as we're the pure play out here, right? We're the company where you give us the big e-commerce multiple. What should we know about GXO? This split is coming down the pike very, very soon.
Yeah, so the way I try to describe this to people is this is the Amazon logistics for everyone not named Amazon. There isn't a single retailer that can match Amazon on scale, and that's their big advantage. But if you combine your back office, if your logistics with other big players, you can match them on scale. And GXO is trying to position themselves as basically that. They have a who's who list of customers: Apple, Nike, Walt Disney, Nestle, PepsiCo, Whirlpool, a lot of others. They are running the outsourced logistics warehousing for these companies. There's three huge tailwinds we're talking here. You mentioned e-commerce. You mentioned warehouse automation. Again, this is a tech play, but also even before the pandemic, and this has only picked up since the pandemic, companies, big companies, they do not consider supply chain and logistics to be their core competency. If they can find someone that can do it for them, we are seeing a trend towards outsourcing, and GXO is playing into that. If you just look at that business, organic revenue up 16%. Year to date, it has won $2.5 billion in new business. The business forward numbers up to like a little over 5 billion if you count contract renewals. It's all going to plan as far as if you believe in e-commerce, if you believe Nike, Apple, all these guys are going to need to get product directly to customers, but they don't want that hassle. GXO is right there saying, we will do that for you. And their goal is to ride this wave.
Yeah, I think people underestimate how difficult that problem is of doing logistics for e-commerce. Just think about the problem of returns. It's hard enough to get things to the customer, but I know I return things semi-regularly that I buy online, and I know people who do that a lot more than I do. It's really difficult, not only to send all these packages in and distribute it out to 1,000 different homes, but then have 200 of those homes send it back to you, and you have to figure out what to do with these products. And that's what a company like GXO can do and really develop a specialty in that maybe Nike doesn't want to. Nike wants to be really good at making sneakers and golf apparel and things like that. And I think there's a role for a company like GXO when there's not a lot of businesses out there willing to invest the type of capital that an Amazon is to do it on their own.
Yeah, and honestly, for most of them, nor should they. Yeah, I mean, reverse logistics, what you're talking about with returns, is a huge potential market that GXO, FedEx, a few others. So, I mean, they're not alone here. But yeah, these are headaches that you can remove from the customer. Now, in terms of this as a growth story and why I'm so excited about this, I mean, right now they're on an annual revenue run rate of about $7 billion. And I know it's dangerous to do total addressable market, but right now by their estimates, it's about $130 billion opportunity for outsourced logistics. But if you look at it, it's bigger than that, because as I said, the real trend right now is companies are just starting to take their in-house operations and outsource it. If you add all of that in-source business, now it's not going to 100% go out, but that 4x that $130 billion market. This is not a winner take all. All these big companies are going at it. I like GXO because of their technology, because of their relationships. But look, I mean, this is a company that, it go from 7 to 14 to 21 to 28 billion in a $130 billion market, and a market that's also, mind you, probably growing. They have to get it right. They have to execute. But wow, I see this almost as more of an opportunity than e-commerce itself right now, because, e-commerce, yes, there's opportunity, but the Amazon's already there. There's a real opportunity to be that Amazon, that big Titan player for so many retailers and kind of establish yourself there. And that's what they're chasing.
Yeah, Lou, so I know you've owned XPO for a long time, and full disclosure for folks, when you look at this split, you're going to be owning both these companies for the long term. What are your thoughts on where these new split companies fit in a portfolio?
So yeah, as of Monday, they are scheduled to ring the bell on Monday, and GXO will become official. And for everyone like me who owns, for every share of XPO you own, you will own a share of XPO and a share of GXO. I'm personally holding both because I like these stories. The architect to put all this together, Brad Jacobs, is going to stay on the trucking side. I think that with kind of the debt and the higher growth side, that there's real opportunities for the trucking to go back to what Jacobs does best, which is consolidate. I think, though, it is more of a transportation play, and it is going to be a foundational element. GXO, I mean, I don't want to get too far ahead of myself, but I really do believe, I mean, we talk at Motley Fool a lot about, finding real market beating opportunities. And me as an industrial guy saying, you don't just have to go to software. They're harder to find maybe, but there are companies that can be real winners, market beaters over time. And GXO, it looks like all the elements are there. And yeah, I'm really excited to see what happens with that one.
Yeah, you mentioned Brad Jacobs. He's one of the best to ever do it when it comes to roll-ups, and that means he's one of the best capital allocators out there. He makes a capital allocation decision. I think it's probably going to work out well, and I'm excited to see what he can do with maybe a little bit more flexibility to make some moves in the trucking space and continue to play that story out. One last a big story from the past month that we haven't got a chance to discuss on the podcast is the billionaire space flight. So we had both Richard Branson and Jeff Bezos fly to space over the past month. You'd be surprised to look at Virgin Galactic's stock over the past month that they had a successful space flight, down 42% in the past month. What do you make of this achievement, right? Private space flight taking place, and then also the broader reaction in the market.
So it's like the cosmic example of buy the rumor, sell the news, where, I mean, Virgin Galactic has suffered, but it was up, I think, almost 200% in the couple months leading up to this. And yeah, we're in a weird moment for this because the accomplishments are amazing. And I can tell myself a story about how there are real business opportunities here, but it is still an unproven market. And, it's kind of funny now that it's happened and the kind of the romance or the mystery is gone, and you have the astronauts who went along saying, yeah, it was kind of cramped though. I mean, I do think it's sort of, this is that weird moment where something goes from idea to reality. I'm skeptical on space tourism as a market by itself. I am bullish on space. I sort of like some of the diversified plays. Boeing and Lockheed, especially Lockheed, are examples of that, where you get exposure to space without kind of an all or nothing bet. But I think we're just kind of in digest mode. That big milestone happened, the excitement happened, and now Virgin Galactic is racing to actually start service, and we're going to learn more and more about just the actual business underneath the brand in the quarters to come. And I do think the market might be saying, okay, we'll see, as far as the business and not the drama or the appeal. So I kind of think that's where we are now, and we probably will be until we get more progress from them.
Yeah, so it's still a market very much in development. We've now had half a dozen people maybe who have successfully paid to go to space, or even the Virgin Galactic. I think all those were employees. So we had a couple folks on the Blue Origin space flight. So still very much a new market, still something where it's a long way before we're at commercial airline status, to go back to where we started this podcast. So I think this is still a venture capital type bet here, and we're seeing the market, I think, maybe evaluate in such a way. Lou, always great to have you on the podcast. Any last thoughts here?
No. I was agreeing with you. I think it's right. This is binary. If you want to invest in this, a small part of a diversified portfolio, don't put your retirement on space tourism, but it is really cool, and it legitimately could work out.
Yeah, I gotta say, I'm very bullish on the Jeff Bezos space wrangler cowboy outfit with cowboy boots to go to space. So I was talking with our producer Tim Sparks before we got on the show. It's wasn't that the Space Cowboys show movie a number of years ago with Tommy Lee Jones and all that stuff? He's bringing it back. But
can I real quick take the counterpoint on that?
Go for it,
dude. You just went to space. You don't need the cowboy hat. I mean, your point is made without the cowboy hat. That felt like overkill for me. But anyway.
All right. Hey, reasonable minds can disagree. Lou, thank you for joining me as always.
Always a pleasure, Nick. Good to see you.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Tim Sparks for mixing the show. For Lou Whiteman, I'm Nick Seipel. Thanks for listening, and Fool on.